In the state where owning a home is rarer than anywhere else, the top end of the market is breaking records, and Manhattan's office towers are quietly staging a comeback. New York is living two housing stories at once, and the numbers are stark. Start with the baseline. By the close of 2024, homeownership in New York stood at $50 and 1.3%. That's the lowest rate of any state in the country, barely over half of residents owning, nearly half renting. In the Northeast, others were close behind. Massachusetts, New Jersey, and Rhode Island sat among the 10 lowest states for ownership, signaling a regional pattern of high costs and dense urban markets. Consider the spread across the map. West Virginia posted an 80.5% rate, and Michigan and Mississippi clocked comfortably above 75%. One region where ownership historically stands tall, another where it slips. Now look at the other half of the split screen. In Manhattan, homes priced at $4 million and above tallied nearly $12 billion in signed contracts during 2025. That was the second biggest year for this echelon since 2006. Buyers signed 1,436 contracts, up 11% from 2010 to 4. Trophy deals, the ones $10 million and up, hit 284. Even if the peak year, 2021, still looms large, with 400 such contracts and nearly $16 billion of sales, 2025 was a surge. The through line runs even higher. Across the country in 2026, the top 10 home sales all cleared $100 million. Every single one. There were 5 in 22, 3 and 7 in 22-4. Now, 10 of 10. In Florida, 6 of those 10 landed in a single state, including a $225 million sale in Naples, recorded as the nation's second most expensive on record. New York's contribution to the nine-figure club included a $115 million off-market deal in East Hampton tied to Len Blavatnik. 2 California deals crossed $110 million, one in May and one in August, underscoring the national shift to nine-figure threshold deals. And yet, back in New York State, homeownership stays pinned at 51.3%. Why? The forces are explicit: property prices that outpace local income growth, intense competition in dense markets, and a severe shortage of housing stock, especially around New York City. In the Northeast more broadly, high land costs, strict zoning, and investor competition keep ownership suppressed. In short, a tight lid on supply and a heavier bill at the closing table. The cause behind the luxury surge, meanwhile, is equally clear: exuberant gains on Wall Street in 2025 and reduced prices across luxury listings combined to jolt activity at the top. That mix doesn't often arrive together, rising capital and falling ask prices, but when it does, contracts get signed. On West 57th Street, 4 of Manhattan's 10 most expensive deals of the year landed on a single corridor, Billionaires Row. 2 were brand new units at Central Park Tower. Another was a resale at 111 West 57th Street. Up the park, a full-floor 5-bedroom inside 220 Central Park South traded in March for $82.5 million. Downtown, a sleek duplex at 150 Charles closed at $60 million. Midtown recorded a $66 million sale at the Aman, New York, in the restored Crown Building. A single-family Gilded Age mansion at 973 Fifth Avenue sold for $46 million in May, a high watermark for a class of historic properties that still commands a premium. That bifurcation, low ownership at the base and record confidence at the top, plays out in commercial real estate too. New York City's office market entered 2022 with heavy skepticism. In the middle of that year, the availability rate in Manhattan's central business district stood at 18% versus 16% nationwide. Availability rate means exactly what it sounds like: the share of all rentable office square footage being marketed for lease or sale in a given period. In the roughly year and a half since, the Manhattan rate has fallen 4 percentage points, down to roughly 14%, while the national rate barely moved, hovering near 15.7%. Manhattan pulled ahead of the pack. The city's office footprint is vast. New York holds 722 million square feet of office space, 8.5% of the national total. Its market value sits around $472 billion, just over 20% of the nation's office asset value. Almost 80% of that space lies in Manhattan, south of 59th Street. In dollar terms, that central business district accounts for roughly 80 to 7% of total asset value across the city. Within that core, the gap between premium towers and older stock widened. Five-star buildings, just over 10% of all office space citywide, have seen occupancy increase in each of the past 4 fiscal years. Lower-tier buildings have trended the other way, occupancy slipping every year. Rents tell a different story. Average gross asking rents in the Manhattan CBD remain down by an estimated 16% from year-end 2019. Adjust for inflation, and the drop is nearly 35%. That matters because even as asking rents lag, valuations and tax levies for offices rose. The path of assessed values and property tax levies for fiscal years 2020-5 and 2026 has tracked close to the more optimistic path, not the doomsday spiral many feared. But the underlying composition reveals why. A step change in supply at the high end and a shift in leased space from lower-tier buildings toward premium towers. In other words, more square feet that exist, and more of those square feet are better quality. Occupied five-star space is growing, lower-tier occupancy is shrinking, yet the overhang is heavy. By the end of October, roughly 70 to 5 million square feet, about 15%, of the 1 to 4-star office inventory in the CBD was available for lease, and roughly the same amount sat vacant. To grasp the scale, the volume of vacant lower-tier space exceeds the entire stock of 5-star space in the CBD, which totals 60 to 7 million square feet. Conversions and renovations are chipping away at the glut. On average, about 2 million square feet of lower-tier office space has been removed from the market annually in recent years, with projections around 1.6 million square feet per year ahead. At that pace, whittling down a 67 million square foot surplus could take decades unless demand accelerates. Even so, leasing has flashed signs of strength that are hard to ignore. Multiple deals in New York City crossed 500,000 square feet in 25, with 2 surpassing 1 million square feet. Capital markets thawed too. A $1.08 billion purchase of 590 Madison Avenue marked the first office trade above $1 billion in years. Financing pipelines reopened, with securitization activity returning to fund large office, data center, and retail assets, even as uncertainty lingered over interest rates, tariffs, and politics. Set the macro backdrop around housing. In December 2025 builder, sentiment nudged up, but stayed subdued. The headline index for builders rose to 39, its highest reading in 8 months, but it remained below the 50 line that signals optimistic outlook. That was the 20th consecutive month under 50, a long stretch in contractionary territory. Drill down, and you see a split. Current single-family sales conditions rose to 42, future sales expectations climbed to 52, buyer traffic stayed weak at 26. Incentives were everywhere. 67% of builders reported offering sales incentives, and 40% were cutting prices. Discounts, sweeteners, the works, an attempt to meet buyers where rates and budgets are. Resale activity improved, but the climb was modest. In November 2025, existing home sales in the United States increased 0.5% month over month to a seasonally adjusted annual rate of 4.13 million. Inventory slipped 5.9% from October to 1.43 million homes, translating into a 4.2 months supply. Months of supply measures how long it would take to sell all active listings at the current pace of sales. 4.2 means roughly 4 months of inventory under current demand. Despite the monthly gain, sales remained 1% lower than a year earlier, and the median price was up 1.2%. One ray of hope for affordability. Wage growth running ahead of home price appreciation, a trend that can slowly ease the squeeze when mortgage costs remain elevated. Then the labor market blinked. By November 2025, the economy added 64,000 jobs, a modest gain after a 105,000 job loss in October, driven largely by reductions in the federal workforce. That left total non-farm payrolls with little net change since April. The unemployment rate rose to 4.6%, the highest in several years. Average hourly earnings were up 3.5% year over year, the slowest wage growth in more than 4 years. When hiring softens and wages cool, demand in space markets can sag. For property, it's a balancing act. Lower inflation pressure helps rates, weaker job growth challenges occupancy and rent growth. Consumer spending and sentiment added more texture. In October 2025, total U.S. retail and food service sales were flat month over month, but rose 3.5% year over year to a seasonally adjusted annual rate of $732.6 billion. Strip out autos and sales grew 0.5% from the prior month. E-commerce led with 9% year-over-year growth in non-store retail. Food services and drinking places rose 4% from a year earlier, their slowest annual gain since February 2025. Meanwhile, the University of Michigan's final Consumer Sentiment Index for December edged up to 52.9, just above November's 51. Expectations improved to 54.6, but current conditions slipped to 50.4. 63% of respondents expected unemployment to rise in the year ahead. Year-ahead inflation expectations fell to 4.3%, an 11-month low. Inflation itself cooled. In November 2025, headline consumer prices rose 2.7% year over year. Core prices rose 2.6%. One important driver: rent inflation moved below 3%, falling under that threshold for the first time since the pandemic, and, before that, the first time since 2014. Because shelter accounts for nearly a third of the consumer price index and is measured with a lag, cooling rent is likely to keep inflation anchored, which strengthens the case for additional rate cuts in 26-6. For real estate finance, steadier rates mean fewer wild swings during refinancings and transactions. In multifamily housing, the best read for 2026 is stabilization. Industry analysis points to occupancy holding around 94 to 95% and move-in rents slightly down year over year, with concessions widespread. The call is for roughly 2% rent growth in 26, biased toward the back half of the year, as operators retain tenants early and new supply pressure eases in Sunbelt markets. Translation: tenant retention is king, slow and steady beats sprinting. What does all this mean for New York? The state with a 51.3% homeownership rate, the city with both a luxury frenzy and an office overhang. First, the affordability gap that kept ownership low did not appear overnight. High prices relative to incomes, scarce for sale inventory, and a dense renter-heavy housing stock in and around New York City are long-standing. The broader Northeast shares some of the same forces. Massachusetts, New Jersey, and Rhode Island also sat among the 10 states with the lowest homeownership rates by the end of 2024. In contrast, places like West Virginia, at 80.5%, and states like Michigan and Mississippi above 75%, offer a stark counterpoint. The divide is geographic and structural, not just cyclical. Second, the luxury market's engine has its own fuel. $20 of contracts above $4 million in Manhattan rode two factors at once: Wall Street's strong year and reduced ask prices on top-tier properties. Volume is the outcome. 1,436 contracts total, 284 at $10 million and above. 4 major sales set along one stretch of West 57th Street. A single deal of $82.5 million at 220 Central Park South, a $66 million closing at the Aman, a $60 million trade at 150 Charles. And not just condos, one historic mansion, 973 Fifth Avenue, shifted for $46 million. Even beyond New York, the top echelon set a new bar. All of the 10 biggest U.S. home sales in 2025 cleared $100 million, with Florida hosting 6 of them and a $225 million sale in Naples alone. Third, the office story is no longer the caricature. Manhattan's central business district improved materially, availability falling from 18% in mid-2024 to roughly 14%. Nationwide availability barely budged to about 15.7%. But the rebound is uneven underneath. 5-star spaces have been winning, occupancy up in each of the past 4 fiscal years. Lower-tier spaces have been losing, inventory to lease and vacant space stacking up. The sheer volume of excess 1 to 4-star supply is instructive. About 75 million square feet available and about the same vacant by late October. The entire universe of 5-star space in the CBD totals 67 million square feet, less than the vacant lower-tier space alone. Renovations and conversions are the relief valve. Yet at 1.6 to 2 million square feet removed per year, relief is slow. The difference this year signals of commitment. Several leases above 500,000 square feet. 2 at over 1 million square feet. A marquee $1.08 billion office trade at 590 Madison Avenue, the first New York City office sale above $1 billion in years. Securitization pipelines coming back online for trophy and essential assets. A city that holds 8.5% of the nation's office square footage at a market value of roughly $472 billion does not reverse in a second, but it does respond to rising demand at the top. One vignette captures the Manhattan side of the split. In March 2022, a full-floor 5-bedroom home at 220 Central Park South traded for $82.5 million. The buyer's limited liability company, traced to the Huizenga family, former owners of the Miami Dolphins, and Blockbuster Video. One home, one floor, $82.5 million. A few months later, a Gilded Age mansion at 973 Fifth Avenue sold for $46 million. Across the East River, a $115 million East Hampton estate shifted hands tied to Len Blavatnik. The city with the lowest homeownership rate in the nation is also a place where a single residential transaction can cross 9 figures. Contrast that edge of the market with the experience of would-be first-time buyers facing a combination of mortgage costs and tight supply. On the national stage in November 2025, only 4.13 million existing homes sold on a seasonally adjusted annual basis, up 0.5% from October but down 1% year-over-year. Inventory stood at 1.43 million homes, a 5.9% drop from the month prior. That translated into a 4.2-month supply. Anything below 6 months is often read as a seller-tilted market. Builders are working to fill the gap, but their confidence index sat at 39 in December, still in contraction after 20 consecutive months under 50. 62.7% of them used sales incentives. 40% cut prices outright. Buyer traffic at 26 thin. This is the pipeline that eventually feeds homeownership rates. The labor market and inflation make the next act hinge on cost and confidence. With unemployment at 4.6% in November and wage growth at 3.5% year over year, the slowest in more than 4 years, households feel the wobble. Consumer sentiment at 52.9 in December, with 63% expecting unemployment to increase, points to caution. At the same time, slower rent inflation, below 3%, anchors the overall price picture. Headline inflation at 2.7% and core at 2.6% in November, together with cooling rent, may pave the way for additional rate cuts in 2026. Fewer rate swings could mean steadier mortgage pricing and friendlier transaction math for owners and lenders. That's the upside of slower price growth. Retail, meanwhile, shows selective endurance. Total retail and food service sales of $732.6 billion in October, flat month-over-month but 3.5% higher year-over-year, suggests spending continues. E-commerce up 9% year-over-year pulled ahead. Spending at food services and drinking places rose 4% year-over-year, its slowest annual growth since February 2025. For urban property, that combination favors well-located and experiential retail attached to dense office and residential nodes. Long-suffering segments like malls found a groove, 30-8 single-asset US KPI. Mall trades closed in the first 3 quarters of 2025, with more than 50 on track by year-end. That roughly 4.9% turnover rate would rank among the highest in more than 25 years. Capital goes where it sees momentum and mispricing, New York's office and retail streets included. Zoom back to the office chessboard. New York's CBD availability rate, a blunt but powerful gauge of slack, dropped to roughly 14% by late 2025. Rents, however, stayed 16% below where they stood at the end of 2019, or nearly 32.5% lower after inflation. That's a squeeze for landlords facing rising operating costs. It's also a lever for tenants who want more and better space without paying premium pre-pandemic prices. The outcome has been flight to quality, a restacking into buildings with better location, air, light, amenities. The five-star slice, about 10% of total square footage, expanding its occupied base for 4 straight fiscal years, shows that restacking in motion. There is a number that looms larger than the rent delta: 77 million square feet of lower-tier space available, and roughly the same vacant within the CBD as of late October. Side by side, the total five-star space in the CBD is 67 million square feet. Absorbing that lower-tier slack by converting, renovating, or leasing at scale will take years at the current 1.6 to 2 million square feet per year pace of removal. The question is not whether demand is back, it's where demand lands. On the residential side, the tally of contracts above $10 million, 284 in 2025, tells you where high net worth demand sits. The surprise is in the median listing strategy: reduced prices on top-tier listings juxtaposed against record capital gains for buyers anchored in finance. The result: more deals, even below the frenetic levels of 2021. West 57th Street's dominance, 4 of the year's top 10 sales, underscores the magnetism of Billionaires Row. Those towers package scarcity, skyline, and status into a clean, single address. They command a premium even when prices adjust downward. Consider one more comparison in ownership. New York at 1.3%. North Carolina, often thought of as a net in-migration magnet in recent years, appeared among the states with the lowest rates of homeownership too, at 65.7%. The Northeast's composition and pricing structures are not isolated anomalies. They are shared by markets with high demand and constrained supply. But New York's position at the bottom of the list is singular. When half a state rents, housing policy and supply matter more, not less. So what happens next? Base case: New York's office recovery continues to outrun the national average in 2026, but it remains a tale of two markets. Availability in the Manhattan CBD grinds lower from roughly 14% as high-end absorption and a steady cadence of large leases persist. Five-star occupancy continues to firm. Lower-tier buildings shoulder the weight of a 75 million square foot overhang, with conversions and renovations chipping away at 1.6 to 2 million square feet per year. Asking rents stabilize, concessions remain embedded as landlords balance occupancy and rate. Assessed values and tax levies track a steadier path, reflecting the improved leasing and the lag in the appraisal pipeline. In residential, the luxury segment remains active but rational. After nearly $12 billion in contracts at $4 million and above in 25, transaction volume moderates but stays elevated relative to pre-pandemic norms. Contracts at $10 million and higher, 284 last year, should hold a meaningful share as Wall Street performance and adjusted asking prices continue to pull deals forward. The core ownership story shifts slowly. New York's 1.3% home ownership rate is unlikely to move without a change in supply. National resale dynamics: 4.13 million annualized existing home sales in November and a 4.2-month supply imply a constrained pipeline. Builders remain cautious with an index at 39, even as future sales expectations tick over 50 and incentives blanket sales channels. 2 watch items could tilt the path. First, the interest rate and inflation bridge. With headline inflation at 2.7% in November 2025 and core at 2.6%, and rent inflation now below 3%, the balance tilts toward easing in 2026. If cuts materialize and volatility remains contained, refinancing risk eases and transaction activity broadens. If inflation re-accelerates or shelter costs re-tighten, borrowing costs could stay higher for longer, suppressing mobility and throttling volumes. Watch shelter's contribution and the pace at which falling rent inflation flows into headline measures over the next 6 months. Second, the labor market. The November uptick in unemployment to 4.6% and modest job creation of 64,000, paired with slowing wage growth at 3.5% and consumer sentiment stuck near 52.9, signal fragility. 63% of consumers expecting higher unemployment can become a self-fulfilling brake on spending and moving. If hiring weakens materially, space absorption across retail and office could stall, concessions could widen, and effective rents could slip. Conversely, if hiring steadies and wage growth moves toward price growth, the affordability needle could shift while avoiding a consumption shock. Watch monthly payrolls and the unemployment rate through mid-2026 for direction. New York's real estate market has never been a single story. It's an empire state of contrasts, a 51.3% homeownership rate versus a skyline carving 4 nine-figure contracts into one street, a 75 million square foot overhang of lower-tier offices versus 5-star towers with 4 consecutive years of rising occupancy, rents 16% below their 2019 level in nominal terms, but valuations and tax levies tracking an optimistic path. The city that holds 8.5% of the nation's office space never moves in tandem across all its parts. The split screen remains, but the picture is sharpening. If you want more grounded, numbers-first breakdowns of this market, as it evolves, make sure you're here for the next chapter.